Welcome to this presentation of Equity 101, Cap Table Essentials for Founders. My name is Jeff Erickson. I'm excited to be part of Fort Collins Startup Week. A little bit of background on me. I'm with Carta, the leading provider of cap table management software and 409A valuations. I'm also a former founder, ran a company for about 14 years before selling it. I also do a lot of mentoring with entrepreneurs, and I'm an advisor to a number of startup companies as well. Love working in this space and excited to talk a little bit about equity today. So here's a quick agenda of what we're going to cover. First, we'll go over some of the basics of equity, common versus preferred shares, convertibles. We'll talk a little bit about stock options and some things that go along with them. And then we'll talk about some cap table essentials. We'll talk about what is your cap table and why is it important. And then finally we'll get to some best practices when it comes to managing your cap table. And then at the very end, there is a special offer for Fort Collins Startup Week attendees. So let's get right into it. Okay, so when we're talking about equity in your company, we're really talking about ownership. And there's two types of ownership. There's first economic ownership, and there's also governance ownership or control. So your economic ownership is where, if I invested $1 million in your company at a valuation of $10 million, let's say I have a 10% economic ownership. If the company later gets sold, I will get 10% of what comes in. And then this is very different from your governance ownership. You may have an investor that actually has a controlling governance ownership and owns 51% of the governance, but only owns a minority ownership in terms of economic ownership. Often the governance is spelled out in terms of a board seat participation and things like that, but it's very important to make sure you understand these two types of ownership when it comes to your company. We're going to focus specifically on the economic ownership. So when it comes to economic ownership, you're going to be issuing shares, or if you're an LLC, it would be in membership units. But same concept, when you're issuing shares, you've got two types of shares. You'd have common shares and preferred shares for investors. I'll briefly explain the difference. First, your common shares are typically what are given to you as a founder and your employees, your advisors. These are the shares that have the lowest preferences or the lowest rights associated with them. This is in contrast to your preferred shares, where they have what are called preferences. And that simply means that your investors who would receive the preferred shares, they would have a preference on getting their return back first on the money they've invested before you as a common shareholder would be able to participate. So that's kind of a basic definition of your common versus preferred shares. The other thing that you're going to probably run into if you're talking to investors in the early stages are convertibles, convertible notes, and you may have heard of SAFE agreements or simple agreements for future equity. The concept of a convertible is that they would convert at a later date into equity in the company. So if I invested $1 million in your company today and we said, well, let's not worry about a valuation today. I just want a 20% discount, for example, on the next price round, then I would get that benefit of that discount because I'm putting some early money in and I want that a benefit for being early to the game. So I would typically do a convertible note or a SAFE and convert that into shares at a later date when the company raises its next round of financing. So that's the concept of a convertible instrument. And then let's briefly talk about stock options. So with stock options, the reason you'd issue stock options are often to employees to attract top talent. Especially as an early stage startup, you probably don't have the capital to afford the very top talent, and yet that's probably what you need and want. In order to do that, you may not be able to pay the top salary, but you can also issue stock options or equity to these employees. Typically, your top performing talent is also going to want to have some participation in the upside of your company as they're going to build it with you. And so you would issue your employees what are called incentive stock options. In contrast, you might have advisors or others that come in and help the company, and you would issue them stock options also in some cases. And those would be referred to as NSOs, or non-qualified stock options. And the difference is simply there are tax benefits associated with incentive stock options, or ISOs. The key point for you is you need to make sure that you're keeping track of who you're giving ISOs to and who you're giving NSOs to, because there are tax consequences for either option. So that is the difference between ISOs and NSOs. The other concept when it comes to stock options is that you're giving your employees or your advisors the right to purchase your stock at a strike price. And in order to come up with that strike price, often you'll do what's called a 409A valuation. 409A refers to the section of the IRS code where the IRS says, we want you to use a third party to validate what the valuation of your company is when you're issuing these stock options. One of the main points here that I want to make is that your 409A valuation is very different from the valuation that the investors are going to put on your company. Two completely different things. The 409A valuation is a compliance valuation specifically for the IRS in setting the strike price for your stock options. So don't get it confused with the valuation that the investors will put on your company and invest in your company at. Another concept I wanted to talk about briefly when it comes to stock options and also to your founder shares is vesting. Vesting is a concept that you're going to want to understand as a founder, because the last thing you're going to want to have happen is you bring in a co-founder or an employee, a key employee, and you give them 10% of the company. Well, if they leave 3 months later and they take that with them, they really haven't added a whole lot of value potentially to warrant that 10% that you just gave them. And so there's this concept of vesting and having them earn that equity over a period of time. So you might grant them a percentage of the company or a number of stock options and have them earn that over time. So it incentivizes them to stick around and contribute to the growth of the company. So a common vesting scenario might be that you would issue somebody stock options. They would vest over a 48-month period of time, or 4 years. But you might assign, or you might have it have a 1-year cliff is very common. And what that means is that during that first year, no options would vest. So if that founder or employee left in the first year, they wouldn't vest any of their shares or earn any of those shares. Once they hit that first year, if it's a 4-year vesting period, then they would get 25% of their shares or options at that 1-year mark. And then they would vest monthly, for example, over the next 3 years. So hopefully you kind of get an idea of vesting and where you might use that and how that's applicable. So we've covered some of the different types of equity. We talked about issuing you as founders and some of your early employees, potentially some common shares, your advisors. Your investors would receive preferred shares, and then you might start issuing a convertible note or some safe notes to early investors, issuing stock options, making sure that you are keeping track of whether they're ISOs or NSOs, keeping track of vesting schedules, issuing more shares as new employees or new investors start to come in. And you can see you might have additional stock options as well as you hire more employees with new vesting schedules to keep track of. but you can see that it can kind of get out of control here pretty quickly as you start to do more issuances of securities. And so how do you keep track of all this? This is where it gets into your cap table. So this is the purpose of the cap table, is to keep track of who owns what in the company. Your cap table is going to show the different types of securities. So your preferred, you can see this particular company has preferred and common, and also some convertible notes and some warrants. Your cap table keeps track of all of that, and then the different series of investments that come in as well. So here are some things that your cap table will keep track of. First off, how much equity does each founder own? And then also each investor down the road. How much money's been invested in the company over time? Who owns what types of shares? And how big is the option pool when you start to issue out stock options to employees, for example? You typically set options aside, or set stock aside, that you can grant to your employees as you hire them. And you'll have what's called an option pool. So it keeps track of that. And then it keeps track of the valuation of the company at each stage of investment as well. So you might ask, so why is the cap table so important? There's a couple of reasons. One of the main things that you as a management team will have to deal with is, how much equity do you want to give to people, and how much is left to give? So as you are looking at investors down the road, and you've got employees that are coming on, it's important to keep track of how much equity you've already given out, because you really only have 100% of the company to give away. And as a founder, you don't want to give away 100% of the company, because that means you don't have anything left. So the cap table will keep track of that for you. It also records any changes in ownership in the company. You might have investors that come in, and they will get new shares, and those same investors might invest in future rounds, and then they would have a larger percentage of the company even. So it keeps track of the ownership over time. And then it will also help you to prepare for your funding rounds. So as with each investor, as they come in and they get more equity, that will dilute the other founders or shareholders, how much equity they have, or the percentage of the company they own. Being able to project that out and seeing what a future fundraising might do to the dilution of the company's equity is super important. So again, something that your cap table is very useful for helping you to do that. It will also help you to prepare for future funding rounds as you model things out and say, what does the company look like if we give up this much equity for this amount of money? It will also help you to track the options and the vesting schedules of your stock options for your employees or advisors. It also helps you to keep track of who is on your cap table, so that you don't end up with a lawsuit of an investor that invested and you left off the cap table. It will also help you with your investor due diligence. One of the first things your investor is going to ask for when you start to raise capital is to take a look at your cap table. So, what are some of the things that an investor might look for when they ask for your cap table? One of the first things they might look for are errors. Are there errors in your cap table? Are you doing a good job of, having a stewardship over the equity that's been entrusted to you as a founder? If they see errors, that's going to throw up some red flags in terms of potentially even your management ability. The other thing they'll look for is, do you as a founder and your employees have enough equity in the company to keep it going long term? If they put money in and you have multiple funding rounds that will be required down the road, they want to make sure that you have enough equity to keep you incentivized and in it for the long haul. They'll also be interested to see if there are employees that have left the company. They might ask why. It might be a co-founder that left, and they would ask, what's the story behind that? Well, that's going to show up on your cap table. The other thing that they might look for is who else is invested in the company and how much do they own? If they see unreputable investors on your cap table, that's going to throw up red flags and they might shy away from that investment. On the flip side, if they see some really good investors that they want to be associated with, then absolutely, that probably gives you, a good data point to invest in that company. The other thing they'll look for are any liquidation preferences or participation rights from previous rounds, where investors may say we need, our investment plus, a percentage more before anybody else gets their investment or gets to start participating in the upside. And they'll look for things like that that might throw up some red flags for them as well. Or they may at least want to have those same participation rights in their round. So those are all things that investors will look for. As you can tell, there's a lot more that they can tell about you and your company than you might think from just giving them your cap table. So what are some best practices when it comes to managing your cap table? Well, the first thing that I tell all of the founders that I work with is make sure you get a good startup attorney. Don't skimp on this. Even early on, get things set up right from the beginning. And a good startup attorney that has experience working with startups will be able to guide you in the right way. So very important point there. And it leads into this next point, which is to do things right. Good startup attorney will help you do that, and do things early. So right out of the gate, set things up properly so you don't have to fix things down the road. It actually gets a lot more expensive when you have to fix things than if you just do it right from the very beginning. Another thing a good startup attorney will help you do is keep things simple. They know what's standard out there when it comes to investment terms or how to structure things. Keep it simple. That will make it so investors don't have to ask a lot of hard questions because they've seen it all before. Okay, so one other thing I wanted to talk about here when it comes to managing your cap table is historically it's been done through where your attorney would draft up documents and you might issue paper stock certificates or have everything kept track of in a spreadsheet. Well, what often would happen is that the company would tell somebody that they're going to give them equity and say, yeah, we'll get that issued to you later. They forget to tell the attorney about it. And now you've got a mess when it comes to reconciling your cap table down the road when you're trying to figure out who you gave what to and what promises you made. So one of the ways to avoid this is to do this in software. Issue your securities all digitally, so you've got one place where it keeps track of everything, and it keeps a ledger of everything that's happened that impacts your cap table. This also helps you to automate your cap table management, so that when you issue securities, it automatically updates your cap table, so that when your attorney goes in and looks at your cap table, they can see that they're working off the same thing the same cap table or version that you're working off of. Working in software also enables you to do some of the modeling. So it's got a lot of built-in modeling capabilities so that you can kind of project out what's going to happen to your cap table under certain investment scenarios. And again, it provides a single source of truth so that, you, your accountant, your attorney, you're all working off of the same document and you don't have multiple spreadsheets floating around. So in this regard, this is where Carta comes in. We do, like I said, we're the leading provider of cap table management software and also 409A valuations. For Startup Week participants, we actually have a special deal where if you do need a 409A valuation and you're issuing out stock options, reach out to me and we can get you a discount on your first year. Also, for companies that have raised $1 million or less and have 25 or fewer stakeholders, we can actually let you use the Carta software for free. Again, this is something very helpful for early stage founders in particular. Helps you to do things right from the very beginning. And it sets you up so that you're able to model things out for future funding rounds. And it also puts you in a good spot if you're getting ready to raise capital and your investors are going to want to see your cap table. So I'll leave you with that, but I hope this session has been helpful as we've covered some of the basics of equity and cap table management. My name is Jeff Erickson, and again, you can reach out to me if you have questions or if there's any interest in taking advantage of this special Fort Collins Startup Week offer. Again, thanks for being part of Fort Collins Startup Week. I hope this was helpful, and enjoy the rest of your time at Startup Week. Thanks. Bye.